Okay, everyone, welcome back. Well, this video is about credit. There is really no better time than right now to understand how credit works, how to manage it, and why it's so important. At this point in your life, you have, if you're younger, you have probably some very limited credit history, and that's a good thing because starting now, you can take steps to keep your credit in good shape. Credit is one of those things that are important for on a number of levels. For short-term goals, it's going to be important when it comes to renting a place to live, maybe even opening a checking account. So let's list some of these out. Short-term, why this is important. You know, Getting a place to rent. A landlord can check your credit to see if you're a good risk. Opening a checking account, banks may check your credit before giving you an account or before deciding what sort of an account you're eligible for. Getting a job, employers can check your credit before extending an offer of employment. Even establishing phone or utility services. Right? Sometimes with the phone and utility services, your deposit might be affected by your credit rating. So the worse your credit, they may ask for a higher deposit or ask you to pay in advance or something like that. Of course, then there's the big things that you always think about, the major purchases like cars, even appliances, things like that. If you're going to do any of that using credit, then your credit score is going to be important. And one that doesn't get talked about a whole lot are other rates. So, for example, insurance companies, if you have bad credit, believe it or not, like if your auto insurance company discovers that you have poor credit, they may actually increase your insurance rates, even though you wouldn't think that your driving habits have anything to do with your ability to manage money. An insurance company may, in fact, increase your rates just based on your credit score. So that's an important thing to know. Of course, the long-term goals are a little bit more commonly known. So purchasing a home is one of them, or refinancing a home if you already have one. Starting or purchasing a business. Starting or buying a business. Right? Your credit will likely be important there because you may, it's going to be important if you decide that you're going to go seek some debt financing to help support that purchase. So, most people don't realize how important good credit is really until you need it. It kind of lurks in the background, and it's one of those things that doesn't really make any difference in your life that you can notice until you need it. And at that moment when you need it, it's very frustrating to have to deal with issues or deal with problems on your credit report, whether they are real or whether they are not real. And what I mean by that is sometimes the credit, what's on your credit report is just wrong. And so, even if you haven't done anything to deserve it, it's still there, and it's up to you to really go fix it. So it's really the key thing. I guess one of the key lessons here is to start early, to understand, what this is all about, and then really develop some good habits for maintaining good credit. And then you'll really never have to worry about it. So the way I like to think about it, think of a high credit score as really a game and kind of a life game. Take actions, do specific things for the simple purpose of increasing your score. So we'll talk about some of those things that you can do in a video blog series on keeping or maintaining your credit score, but even taking out a credit card and barely using it. There are some strategies that involve instead of not having that credit card, believe it or not, having the card increases your score or could increase. Oops, sorry about that. Could increase your score even if you never intend to use it. So there's some myths out there about credit and about how to increase your score, and we'll get into those details in a video blog. The purpose of this video is just to give you a high-level overview of credit, why it's important, and to give you some tools, and then refer you over to the video blog videos on this series also. So let's just talk about the word credit for a minute. What is it? Well, credit is you can think of it just simply as the ability to borrow. Okay, the ability to borrow tomorrow's money to pay for something today. So tomorrow's money to pay today. Okay. Now, it probably goes without saying, but a creditor is a lender, someone who actually provides you with the credit. Oops, lender, sorry. Credit comes from many sources. You can get credit from credit cards, personal loans, and those could come from banks, those could come from your parents, those could come from all kinds of folks. A mortgage is just a credit that's given by a mortgage company on real estate, and so forth. So those are the most common forms of credit. Of course, credit cards, that you can boil this category down to, there's store cards, right? There's the major ones, MasterCard and Visa, but then you have store cards, and I'd even stick in here, kind of that whole same as cash concept. That's just credit. When someone says that they're giving you 6 months same as cash, what they mean is they're giving you 6 months worth of credit. And so in order to get that same as cash, in most cases you have to qualify for it, and that means they're going to go check your credit. So one of the most important, so let's talk about your credit history. So your credit report really shows others how you have managed credit in the past. So there's this, your credit report. And by the way, there's three main agencies out there that that track credit. I think you've probably heard of them. Let's see if I can remember them. I don't actually have them written in my notes, but Experian, TransUnion is the second one, and the third one is Equifax. I think those are the three credit reporting agencies out there that folks will report. People who are your creditors will report information to these agencies, and that's what forms your credit report. Okay. So one of the most important parts of your credit report is whether you make payments on time. Let's just put this in red because it's the whole concept of being on time that's very important for maintaining a good credit score. Okay, so if you're late, if you're 30 or 60 or 90 days late, one of your creditors will report that to one of these to one or all of these credit reporting agencies, and that'll be a negative mark on your credit score. Okay, so the whole concept of credit scoring really is you kind of start with a perfect score, and then things that you do impact that score to make it go down. All right. Then there are ways once it's down to help restore it. Again, like I said, we'll talk about some of those strategies in another video. But the idea is that you kind of start with a clean record, and it's up to you to screw it up. So you're pretty much in charge of seeing how all of that happens. Okay, so then if your credit history has some problems, like if you do have a problem here with some late payments, you could be denied credit in the future by a creditor. They may just say, we see some problems on your credit report, and we're just not into giving you credit right now until you get those things cleaned up. Or if they do, they may charge you a higher rate, higher percentage. So someone with perfect credit might have gotten a 5% interest rate. You might get an 8% interest rate because of your credit score and so forth. And so that 3% difference, obviously can add up to substantial dollars over time, especially if it's on a larger purchase. Okay, so here's a good example, and I'm running out of room, but I'll try to squeeze it in here. Let's say you purchase a home or investment property for $125,000. Let's change the color so we can kind of follow this. So let's say that you purchase it for $125,000. And let's say you have great credit and you can get a 7% loan for 30 years. Okay. Each month your payment's going to be $831 and change. Let's just leave it at $831. And this payment includes principal and interest, right? It's an amortizing loan. And after you make your last payment over 30 years, you'll have paid $299,000 $386. Okay, so now suppose your credit isn't as good and you can only get a 12% interest rate, so you're still borrowing $125,000. But let's say the mortgage company comes back to you and says, yeah, you're only worth 12% to us because you're kind of higher risk, 30 years. Well, your monthly payment, including principal and interest, is $1,285. So you can already see the difference just in the monthly payment. And so, I mean, again, if this is your own house, you can see the difference in cash flow. If it's a rental property, you can see that you'd need to collect more than almost $500 more a month in rent just to break even because of this higher payment. Okay, and now look at this. After 30 years, your total payments on that loan are $462,875. Okay, that's a difference of $163,488, roughly, in additional interest that you have to pay the bank. All right, so the bank wins. You've just paid that money over to the bank and have really got nothing for it because you got the same house. You paid for the same exact house. You paid back the exact same amount of principal, but you paid that much more in interest. Okay, so just kind of a quick example, but an important example of how credit can really impact your financial future. Okay, so one of the things I'd like you to do just in your spare time is think about who are your creditors right now. You know, think about anyone who sends you a bill, or said differently, anyone to whom you owe money. So student loans, utility bills, your cell phone provider, credit cards, insurance company, a mortgage company, landlords, or banks. I mean, just list those things out, identify who they are so that you can make sure that you're doing all the right things with them. Okay, so very quickly, let's just talk about one thing that you can do to establish good credit, and the most important thing is to actually use it in small doses. Okay, so and then pay on time. So in order to establish a credit history and a credit report and a credit score, you actually have to use credit. Okay, so avoiding credit isn't going to do the trick. You actually have to have some credit and demonstrate that you're using it responsibly. So, but my recommendation, at least to get started, is to have a small amount of credit. Don't overextend, and when I say credit, I mean credit availability, right? So just the amount of credit. So don't go out and get a credit card or try to get a credit card that has a $25,000 line on it. That's not going to help you. Rather, maybe find one that's got a $2,000 line or credit availability. Use it for small things during the month, and then pay that bill on time. And you're going to start building a very good record and a very good credit history just with that small steps. Okay. And don't forget, this also includes utility bills and cell phone bills and rent. Don't forget about them, and just focus on credit cards and student loans and those kinds of things. Anybody who sends you a bill has the ability to report bad payment history to a credit bureau. Okay, one last thing before we go, and then I will we'll cover some more of these topics in some specific videos. But you are entitled to one free annual report every year. And you can go to www.annualcreditreport.com and just follow the instructions there, and you should be able to receive one free report per year from that organization. So I recommend, if you haven't done that, to go ahead and do it and see if there's anything that you need to get working on. Okay, that's all for this video. We'll see you in the next one.